Good morning, everybody. It is Monday, June 2nd. We have a new month and new money coming into the market. We are going to start our prep for today and review what happened on Friday, as well as give you some big changes that are coming in the markets, some big shifts that we're starting to see happen, and how you can prepare yourself. First, as always, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, we'll start off with our COT report, where we consistently have seen uh, the commercials control the market, and we're now seeing a big shift here. Some things that should stand out are on the S&P, a negative 47,000, almost 48,000 change from last week, which tells us that commercials on the move higher these last couple of weeks have been selling. And we can see that very clearly in terms of what their position is doing. And we also see that in the chart here. So if we look at what's happened, they built a position back in April, and we follow that on the COT. This is not subjective information. This is purely objective. They were short, and then this is where they started going long. And if you are familiar with value areas, you can see the value area and the point of control. And then we broke out, so they're pushing to distribute. Now they've re-added to their position, so we add that in. And now we've been staying over that value area high. And in this, they went from a 60,000 position or 58,000 down to a 10,000. And so they sold 82% last week. So they are profiting very handsomely in this. Um, at the same time, we are seeing on the VIX a 10,000 position shift, which puts us from negative back to positive on a position. So instead of being short the VIX, which again, if we take a look at what happened, traders or commercials went short the VIX, pushed the market up to push their position higher. Now they're adding in the VIX for that protection to the downside. Now, when we look at our numbers here, we're not near triggering levels. We go into that in depth with our students, how to look at this and how to use this. But we are seeing the VIX start a positive position, a long position, which starts to add a little risk to the markets. Uh, if we look overall, and we've mentioned this many times, is this looks very similar to what happened in 2022. This was our systematics and algorithmic trading, and they are on the sidelines for the next 4 to 6 weeks. So when we look at the big changes coming, they are not looking to be participants until what is likely going to be July, possibly August. We saw this play out back in 2022, where systematics were on the sidelines. Fund managers went from 19% invested, meaning 81% of their capital was on the sidelines, to 78% invested. And that was that rally. They had to chase for performance, put out their mutual fund stats or their hedge fund stats that showed that they're part of the rally. And then the market came down to a new lower low, wiping them out, taking out a lot of capital. What we've seen during this move up the last month is very similar. We've seen commercials go long. We've seen commercials go short on the VIX. We've seen systematics go to the sidelines. We've seen fund managers go from 30% invested, so 70% of their capital on the sidelines in this April move down, to now performance chasing. And last week they got to 88% invested. So there's 11.59% of capital on the sidelines. So now we start running out of money to push the market. At the same time, we're seeing commercials begin to position themselves in the opposite direction. So what that doesn't mean for us is that we know exactly when a sell-off is going to start in terms of what day. What we do know is we will follow our lines in the sand and our levels every day. And if we break our line in the sand, we know what to do with that. The question for you is, with these risks being present, do you know where your bias will change, when it will change, so when to watch in the market, and how to capitalize on that? And if you're unsure, we do offer several courses, as well as a Discord room, and we cover some of those for our subscribers, but we really go in depth for our students so that you can learn not just the ES, but any instrument and how to capitalize on this. Lastly, on this, another big change for you here, or not big change, but one to note is Bitcoin still a max long position. So commercials are continuing to add, looking for a push to distribute into. And so those are the big signs that we're looking for in terms of our COT. Now, high yield, again, we've mentioned this before, there is no uh, real recession risk being priced in terms of the high yield space. So we're just going to watch that 3.5 again. We mentioned that last week and a couple weeks. Now, if you don't see how one string pulls the 10 others that are connected, as everything in the markets are interconnected to varying degrees, we have an ecosystem that has tens of trillions of dollars in it. And all of this is connected. And so without printing new money, you are just moving money from one pot, equities or fixed income, to another. At the same time, commercials are distributing their SPX position and their their S&P minis position to capitalize. The bond market has maintained complacency even with the tariff turmoil and stagflationary readings. Is this a coincidence or a function of business? I would say it's both. We've been on the lookout for bond vol to start spiking back up to the upside. On the move index, we're looking for a move back to 104 to 108 in the coming days. And if that occurs, look for sideways to downside to be the prevailing move in equities. Again, it all comes down to the positioning, and traders were positioned for bond vol to spike, and then as bond vol did spike, and then it's come down now, the cost of business changes, complacency comes in, and now we're looking for that to shift after people have gotten too comfortable. And we see this again continuously in the commercial side of the market, where if you think of all the market making firms, they see the other side of your trades, they position themselves accordingly. And since they have to make the markets, they choose where they're going to put their bids and offers to maintain that neutrality and capitalize on those spreads. And that leads to these moves that we can see based on how the positioning is. On cross asset class vol, we are watching for the VIX to break under 18. If it does, that'll give us signs for longs. If it doesn't and it gets back over 20, then again, we're adding more risk to the market. So this cocktail that's being positioned is commercials cutting their position, adding to the VIX still holding over its key level, unable to break down. We're seeing capital running out on the sidelines. The risks are starting to pile up. That doesn't mean that we have to go down, but we're starting to set up that move for the downside that a lot of people are going to keep price chasing and following the narratives that everything's okay. If the VIX breaks under 18, then we know to look long. If we stay over our line in the sand, and we monitor where that is, as well as insurance trading during the day, we know how to use that and how to position ourselves for the upside. Just want you to all to be aware of what is happening under the current, under the surface in the markets. And so if the VIX gets over 20, that's this dark blue line here. We're going, and the 20 is the gray line here. On the right-hand scale, you have the OVX, so oil volatility. If we see the VIX get over 20, we look for the downside. We're also watching the VIXN, so the VXN, NASVOL. If we see that break under 20, then it gives us more legs for upside. But otherwise, now that NVIDIA earnings are over, the focus is going to shift to the macro picture, and that is jobs reports, inflation data, which should begin to accelerate again as we've now removed the favorable comps and rolling periods out of the sample set, and oil has also started to stay sideways, but with an upside favor, and that is a factor into CPI. So we're going to see that tick back up, and that is going to give more stagflationary signals right ahead of the FOMC meeting coming up in a couple of weeks. Another factor adding to the risk in the markets, and we watch this as well, is the cost of doing business began increasing at the end of May. When we think of the cost of business, we look in terms of premiums and discounts, and you can see, so the red bars here are the daily returns. When the cost of business is higher, the daily returns on average are lower. When the cost of business starts coming down or when it gets below, then we start seeing more favorable upside. We follow this on a moving scale as well. And you can see when the cost of business changed, we had our big 9% up day. And now as the cost of business started changing again, we've seen these bigger downside, more downside favor and the bigger downside move that came last week. So since May 22nd, we've seen the cost of business increasing. If that cuts back, again, that will favor the upside. If that stays elevated, this is getting very shaky. And There's a lot of pieces to this puzzle. Commercials are still long that 10,000 contracts, but they could sell the market down and they are still going to be very profitable in this move. So we are watching this as if the cost of business rises, capital has to be deployed in a more measured manner. This leads to wider swings and opens the door for that downside. Whereas if the cost of business is cheap, a lot of money can be deployed at every tick, and that leads to that smaller range, smaller market, more contained, and typically more upside favored. Now, lastly, here before we get into our levels for the day, our washing machine is going to return again this week. Our forecast in the insurance market right now is saying underinsured with lots of storm clouds approaching. But unlike the weatherman, we do have a better track record on getting this right. We have JOLTS, ADP, and NFP on the job front this week, with trade balances on Thursday and Powell speaking today at 1 p.m. Eastern. We're going to likely see many additions, as we've seen the past few weeks, from POTUS and gang to control the narrative. So whether it's Bessent, Navarro, POTUS himself, or the press secretary, we are going to get some of those coming in. And again, we will look for insurance buying because everybody's always on watch for what comes out of this administration. So the way that that plays out is we watch for downside pressure to continue in the markets on the insurance buying. Everybody starts to buy insurance, and that drops the market to make that insurance more valuable. As the clouds get closer, people start to panic and buy and buy and buy. But you drop the market and you make that seem even more scary, and you can raise your premiums. Once that's done and that demand for insurance is out of the market, the insurance providers, we see this time and again, push the market back up to devalue those. Look no further than Nvidia last week. Everybody had to buy insurance for Thursday since earnings were after the bell. We pushed up to 6,000 in the overnight session before coming all the way back down and retracing. But all of those insurance policies were worthless by the time the market opened. And remember, people have to buy insurance to protect typically the capital of their own if they want to be safe, but really they have to for if they're managing other people's money. And that is what causes these moves. And again, when the market makers or the insurance providers see the order flow coming in, then they protect their books by pushing the market back up on all of that positioning, and changing the way they structure their bids and the offers, allowing for that devaluation of those policies, and protecting themselves. So there will be a lot of washing machine chop this week and next when we get into CPI and PPI. As you can see, we are underinsured on everything. We'll look for at least the yellow zone tomorrow on JOLTS and typically into the red zone on Wednesday and Friday for ADP and NFP. And then again for CPI and PPI. And then we mentioned this before in terms of our systematics. The structure and positioning are similar from a macro environment. The big thing that's the difference here, we've seen a lot of comments that this is the best May since 1990. And while that is true, a lot has changed in 35 years. And this move in July of 2022 is the best move in the last 5 years. It was a 9% move compared to May's 6% move. So it was 50% better than this past May's return. The positioning and structure are similar between those 2 months, so July of 22 and May, where systematics were on the sidelines, fund managers were chasing, the cost of business was increasing. There are differences. We have a different administration. We have different risks. At that time, in 2022, we had inflationary pressures. At this time, we have tariffs and economic headwinds. In 2022, Europe and Eastern countries were facing a manufacturing recession. The US was fighting inflation, but foreigners were willing to put their money into US markets because it had a better return and it was more free flowing in terms of capital, leading to the Mag 7 outperformance as people sought liquidity and safety. Now Europe is in a bull market, and the DAX, Poland, Ireland have all been outperforming the US equities. And protectionism is rising, causing foreign investors to think twice about deploying capital in U.S. markets. So again, the bond market hasn't been this volatile over duration, and you can look at the MOVE index for the last 30 years. Since COVID and the global financial crisis in 2008, we haven't seen the MOVE index consistently at these levels. So with all that being said, this is looking more like 2022 than 1990. A lot has changed. We can see a lot more, and the risks are beginning to stack up. So just be sure to control your risk, whether that you're a swing trader or day trader. That is the number one rule. Protect your capital so you can stay in this long enough. Uh, Now, with all of the macro picture behind us, we will dive into our levels here for today. So on to our uh, ES levels. So I put my levels in here for today for our subscribers. You can see those. We are looking for rotational price action from 58.71 to 59.44 with our pivot at 59.03. If we get over our rotational high, again, the cost of business changes. Commercials want to push the market once more. All the insurance buying comes in and gets absorbed, and they push it up. Um, any of those could lead to that, and that would put us with targets of 59.76 and 6,006. If we go lower, we have to break our line in the sand under our rotational low at 58.51. But if we break that, we're looking for 58.32, 58.15, and if things get very volatile, 57.86. Our minor line in the sand is at 59.16. So again, staying underneath that brings a lot of risks. We saw that last week where the line in the sand, the minor line in the sand was resistance early in the morning and pushed us right down to our major line in the sand at 51. We laid that out for you on Friday that we were looking for choppy price action, 59.20 to 58.90. 58.70 was our lower rotational zone, and 58.51 was our line in the sand. We came down to 53, held our line in the sand. Billions get deployed by Chicago, pushed us right back up, and up to we had a key level at 34.5. We missed that high by 6 ticks. The high of the day was 33. So close enough when you're talking a 70, 80 point move. But we look at the positioning to find that. We don't just randomly find these levels and see that. We knew that there was a large position. And if you go back to Friday morning's video, we told you that 58.67 would be a key level. There's a $5 million bid there is why. And that bid is still there. We verified that on our data. And if you want to happen to guess what the Globex low is, to the tick, 58.67. So again, we follow the positioning because it matters. Globex has much lower volume, and so those $5 million bids can matter more. Whereas in RTH session, once the US opens, we look for the 20, 30, $50 million plus bids because with higher volume in a liquid market, we need bigger positions to stop it. So again, for today, we get under that 58.51. We're looking for those lower 5800 levels. Some other key levels for you today are 59.31, 58.83, and 58.22 3/4. Now on to we'll quickly go through these others here. NASDAQ, we're looking for rotational between 21,177.5 and 21,507 3/4. The pivot is 21,342. The upper targets are 672 and 769 3/4, and the lower targets are 910, so 20,910 and 21,010. Our line in the sand here is 20,734, which is below our lowest expected zones, expected moves. And so that tells us that at least for today, probably tomorrow, things are going to be safer overall. Once the NASDAQ starts to lose its line in the sand, then again, that will add another layer of risk to the puzzle. Other key levels are 21,621, 21,467, 21,383, and 20,992. Now on to oil. I've rolled my contract, so my levels are just slightly different than what you're going to see here. So if you are still on the old contract, just adjust the levels. I believe it's 80 cents. Rotational between 60.80 and 63.11 with our pivot at 61.95. Our upper targets are 64.27 and 64.97, and our lower targets are 58.95 and 59.64. Your key levels on oil, 64.06, 63.63, 62.47, and 61.54. Now, the last thing I'll mention on oil is remember, we are just stuck in a large balanced area. 55 is our low end where we expected some other parties to step in and defend that heavily, as well as our line in the sand being down there. And then our upper end, again, we are stuck at this 64.5, 65 area where we have our upper area where market makers are going to be introducing a lot of supply. So until that moves higher, we are a little capped on oil here. And lastly, on to gold. This is for the Q contract now. So we are looking for rotational from 33.14 to 33.80.3 with our pivot at 33.47.2. Upper targets are going to be 34.13.8 and 34.33.6. Our lower targets are 32.61.3 and 32.81.2. Your other key levels to watch for are going to be 34.68.9, 34.15.2, 3360.3, and 3307.3. And again, guys, remember to control your risk. You have to stay in this game long enough to continue to play and to continue to learn and become a consistently profitable trader. So if this resonates with you, or if you want to learn how to properly view a market and tools to see the positioning, check out our courses that are going to be starting up again in the fall. We just started our advanced course this past weekend for current students, and we will be offering new courses and some new indicators starting in the fall. So have a great week, everybody, and we'll be back again tomorrow.